Delphi Energy is a junior oil and gas producer in Alberta, focused on the Montney formation. The attributes of our Montney play are very high liquids, meaning that our condensate that we produce allows us to generate very high operating netbacks, so cash flow, and attractive economics in terms of finding and development costs. The play that we are pursuing across the large land base has increasing condensate yields as we go from the east side through the west. How we're generating the higher condensate yields and getting it out of the rock on the west side is really through hydraulic fracturing techniques. So we're putting bigger fracs into the rock, more fracs. So we've gone from 30 individual fracture treatments on the east side all the way to 80 on the west side, and so we're cracking the rock more efficiently and allowing those bigger liquids molecules to flow out of the rock much easier. What that's done from an economics perspective is that the net back, or the cash after all the operating costs and royalties that we achieve, is about 60% higher than what we were achieving on the east side. So going from $20 a BOE net back, or slightly under on the east side, to $30 per BOE net back on the west side. So it's much better economics in a more challenging commodity price environment. The part of the growth strategy that Delphi has maintained as we've developed the Montney is to make use of not only our existing infrastructure that we own, some of it 100%, some of it with our partner, and then we've built out the required Montney infrastructure as well. So we own all of that ourselves, and that reduces our operating costs. It does require additional capital that we could be putting into wells, but we've chosen to build out the infrastructure ourselves and produce through our own plants. And what that has done is allowed us to connect our natural gas production specifically to both the TransCanada system, which is an AECO price, as well as the Alliance transportation system, which takes the gas all the way down into the Chicago market, at which that can be the transfer point or the sales point of our gas. So that's been a huge strategic advantage because we can ship on both of those pipes. Our natural gas volumes that we ship on Alliance down to Chicago represent today about 60% of our natural gas production. It has been as high as 90%, but we've chosen to put some volumes onto the TransCanada system and sell in AECO, and actually rent out our excess Alliance space for a premium and take a profit on that market as well. So our realized pricing on those two markets in the second quarter of 2019, we received almost $3.50 an MCF in Chicago, compared to $1.15 or 3 times less through the AECO system. So the economics of shipping the gas all the way to Chicago, selling it in Chicago versus selling it at the Alberta border has been a huge advantage for us in managing what has been relatively weak natural gas prices in Alberta. The second quarter of 2019, like I mentioned, saw only $1.15 AECO pricing, which is pretty weak. That's a pretty tough price. When you put it in perspective, on a per barrel equivalent basis, our natural gas is only getting us approximately $15 to $18 per barrel of oil equivalent, where our condensate, on the other hand, with the hedges that we have in place, is up over $80 a barrel. So the prize, and that allows us to generate the significant cash flow that we do have, is really from the condensate that's being generated at yielding much higher prices. The transaction plan that has recently been announced and will be voted on by our shareholders and note holders in November really contemplates, addressing a number of issues. Number one, for the junior and intermediates in Western Canada, we're seeing fairly significant pressure from the senior lenders who are pulling capital out of the oil and gas business, therefore lending less. So our lending values are coming down, which means that I need to reduce my bank debt. And I've been able to do that through a number of different transactions, and our debt will come down by about 40% from second quarter through the end of the year. But the component of this recapitalization transaction that is most attractive to the company is that on top of dealing with senior lending pressures, we're extending our secondary term debt out 21 months, out into 2023, which gives us a lot of running room. It takes pressure off the banks, and it'll take pressure off the common shareholder equity as well. And the third part of the transaction is actually raising some additional equity. Now it does involve some dilution to the equity shareholder, but what that's going to allow us to do is, while the debt is coming down, we will be deploying that capital into the field and growing the production and the proved producing reserve base, therefore adding to the existing borrowing base that the senior lenders are focused on, and ultimately growing the company and adding value for the equity holders. So that's the concept of it. It is going to be before the shareholders in November for a vote, and we trust that it will be passed and will be a very, very solid piece of business for the company.